Every historic financial bubble has a central pillar, a single asset or company that becomes the benchmark for an entire economic era. In the 19th century, it was the railroads. In 1999, it was Cisco Systems. Today, it is Nvidia. Nvidia is no longer viewed as just a silicon manufacturer. It has become a part of the AI financial engine of the global economy. Over 90% of the advanced chips powering artificial intelligence bear its logo. Its sky-high market valuation and exponential quarterly growth have single-handedly dragged major stock indices to record highs. Because of this hyper-concentration, Wall Street has made a dangerous tacit assumption that the world's largest tech giants will continue buying hundreds of thousands of hyper-expensive GPUs every single quarter, forever. Nvidia has become the ultimate proxy for the entire AI revolution. But that status comes with a terrifying double-edged sword. If the company selling the shovels ever reveals that the gold rush is slowing down, it won't just hurt Nvidia. It could trigger a systemic margin call on the entire AI economy. What could actually trigger the shockwaves doesn't require a technological failure or a corporate scandal. It only takes a single sentence on an earnings call. Imagine a quarter where Nvidia reports that revenue growth has sharply decelerated, or major cloud providers are pushing back delivery dates, or data center build-outs are stalling due to power grid bottlenecks. Suddenly, Nvidia isn't missing revenue by billions, it's simply failing to exceed Wall Street's astronomical growth expectations. The market reaction would be instantaneous. Investors who priced Nvidia, assuming decades of uninterrupted compounding, begin to sell. But as Nvidia's stock drops, the narrative fundamentally shifts. The market stops asking how many chips Nvidia can manufacture and starts asking the far more dangerous question: if Nvidia's customers are cutting back on chip orders, are any of these companies actually making money from AI? To understand why the fallout would be so severe, you have to look at how the AI boom is currently being financed. We are living through a massive, interconnected financial loop. Big tech conglomerates and venture funds invest billions into AI startups and specialized cloud providers. Those startups use that capital to lease server capacity from data centers, which then turn around and buy hundreds of thousands of GPUs directly from Nvidia. Nvidia even reinvests its own profits back into those very same AI startups and cloud platforms, helping fuel the ecosystem that purchases its hardware. This isn't necessarily fraud, but it is an extraordinarily fragile web of confidence. If venture capital funding dries up, or if AI applications fail to generate actual end-user subscription revenue, the cycle reverses. Starved of cash, startups cancel their cloud leases. Data center operators delay expansion plans. GPU orders evaporate. The circular pipeline of capital freezes, and the entire infrastructure spend comes grinding to a halt. This brings us to the ultimate nightmare scenario: the cascading AI margin call. It begins quietly. A prominent AI startup fails to raise its next funding round and goes under. Panicked investors start looking closely at the balance sheets of cloud providers and data center operators, realizing that billions in debt were taken on to buy GPUs that are rapidly depreciating in value. Credit tightens, lenders demand higher interest rates, data center expansion projects are abruptly cancelled, Nvidia's order book drops off a cliff. When Nvidia misses its earnings guidance, its stock plunges. Because Nvidia makes up such a massive percentage of major stock indices, its decline drags down the entire market, triggering algorithmic sell-offs across Microsoft, Alphabet, Meta, and Amazon. With their market caps shrinking and capital costs rising, these tech giants cut their capital expenditures to protect their profit margins. The cutbacks lead to even fewer GPU orders, causing Nvidia to slow down further. The feedback loop seals itself. The greatest threat to Nvidia was never a better chip from a competitor. It was the financial architecture built on the dangerous belief that demand for its hardware could grow infinitely. Nvidia didn't fail because its technology stopped working. It became the domino that accidentally exposed the entire AI bubble.